Imagine you're just, walking up a staircase. You're placing one foot in front of the other in this steady, totally predictable rhythm.
Right.
You lift your foot for the next step, you shift your weight forward, and suddenly an entire step is just missing.
Oh, man.
Yeah, your foot just hovers in thin air, your stomach completely drops. And in the financial markets, like when you're looking at a trading chart, that missing step is called a gap.
That is, honestly, that's the perfect way to visualize it.
Because you expect this continuous, unbroken flow of price data, right? But instead, you're staring at this completely empty space where absolutely zero trading occurred.
Exactly, that structural void. And, when retail traders, people who are just trading their own personal accounts from their laptops, when they see that missing step on a chart, their brain almost always registers it as a system glitch.
Yeah, like their Wi-Fi dropped or something.
Right. They assume their brokerage platform is lagging. But if we actually dig into the architecture of the markets, that empty space is actually, well, it's one of the most reliable, high-fidelity diagnostic tools we possess for tracking where the true power lies.
Which is exactly why we're doing a deep dive into your stack of sources today. We are pulling apart this massive compilation of research, back-tested data, and institutional strategy manuals focused entirely on gap trading.
It's a huge topic.
It really is. And our mission for you listening today is to decode why these gaps happen, even in markets that supposedly never sleep, like crypto.
Which is a huge misconception, yeah.
Right. So we're going to break down the specific anatomical structures of the trading charts you need to look for, map out the precise entry and exit protocols, and maybe most importantly, dissect the risk management you need just to survive.
Yeah, and the foundational premise we really need to establish immediately, like the whole reason anyone should care about a blank space on a screen, is that these gaps are not accidents.
They aren't random.
Not at all. They are the literal, visible footprints of massive institutional money.
Oh, wow.
I mean, when a Tier 1 bank, or say a multi-billion-dollar hedge fund, decides to move capital, they operate on a scale that retail traders can barely even comprehend.
They aren't buying 100 shares on Robinhood.
Exactly. They buy blocks of millions. So that sheer, overwhelming volume hits the market faster than the existing liquidity can absorb it, and it rips a physical hole in the price action.
So learning to read that empty space is functionally learning to read the intent of the market makers.
You nailed it.
Yeah.
You aren't analyzing the paint. You're analyzing the negative space on the canvas.
I love that. So let's isolate that missing step. Let's look at its anatomy. The sources go really deep into the visual mechanics of a candlestick chart.
They do.
And for anyone listening who's trying to visualize this, a standard candlestick has a thick colored rectangle, the real body, which shows you exactly where the price opened and closed during that specific time frame.
Right, the open and close.
And then you have those thin lines protruding from the top and bottom, the wicks or shadows, which show the absolute highest and lowest prices that were briefly touched during that same period before the price pulled back.
Yeah.
Now, the research highlights this massive debate within the trading community regarding what actually qualifies as a true gap.
Oh, yeah. It's highly debated.
Does the empty space only need to exist between the thick real bodies of two consecutive candles? Or does it require a clean, unbroken void between the extreme tips of the wicks?
Well, if you look closely at the data from the institutional side, they consider the real body gap to be mostly just noise.
Really? Just noise?
Yeah, because if you train your eye or your trading algorithm to flag every single instance where the open of a second candle is just slightly higher than the close of the first, you are going to see gaps everywhere.
Right.
Your chart will look like static on a broken television. Market makers and high-frequency trading algorithms are constantly creating those minor body gaps as they aggressively jockey for position microsecond by microsecond.
Wait. Let me play devil's advocate here.
Sure.
If I'm a trader looking at a daily chart and the price closes at $50 on Tuesday, but opens at $52 on Wednesday, that's a $2 gap in the real bodies.
True.
But if Tuesday's upper wick reached 53 and Wednesday's lower wick dropped to 51, the wicks overlap. You're saying that $2 jump isn't a real gap.
I am.
Aren't I risking filtering out a perfectly good momentum signal just because a single algorithmic trade happened to spike a wick into that space?
You are filtering it out, but you're doing so to protect your capital.
How so?
Think about the definition of a vacuum. If Tuesday's wick reached 53 and Wednesday's wick dropped to 51, It means that at some point, buyers and sellers did actually interact in that 51 to 53 zone.
Oh, I see. Transactions still happened.
Exactly. Liquidity was provided and consumed. The true institutional footprint we are hunting for requires absolute zero interaction.
Yeah, absolute zero.
A high-quality, high-probability gap demands empty space between the highest wick of the first candle and the lowest wick of the next candle.
That's strict.
It has to be. That wick-to-wick void proves that for a specific price range, the market moved so violently and so quickly that the order book was completely bypassed. Nobody bought, nobody sold. Price simply teleported.
Okay, so that mechanical distinction is crucial. You're demanding absolute proof of a liquidity vacuum before you risk a dime of your money.
Exactly.
But I have to challenge the premise of when and where these vacuums can actually occur, especially based on the sources. I totally get why gaps happen in the traditional stock market.
Right, the weekend effect.
Yeah, the New York Stock Exchange rings the closing bell on Friday afternoon. The market is physically closed. Over the weekend, some massive geopolitical crisis erupts, or a major tech company announces they've fired their CEO.
Right.
By the time the opening bell rings on Monday morning, the underlying fundamental value of those assets has drastically shifted in the minds of investors.
Drastic.
So the price jumps instantly from the Friday close to the new Monday reality. Boom, a gap.
Okay.
But let's apply this to the cryptocurrency data in our sources. Because crypto is a 24/7 global market.
It is.
There is no opening bell. There's no closing bell. If trading literally never pauses, how can price teleport?
Well, if we look under the hood of this crypto order book, you'll see that while the market is technically continuous, liquidity is definitely not uniformly distributed.
Okay.
You're correct that the traditional weekend gap doesn't really exist on spot crypto exchanges like Coinbase or Binance. However, gaps in a 24/7 market happen precisely because of sudden, intense liquidity vacuums driven by news.
So news still causes the teleportation.
Exactly. Imagine a scenario where a massive regulatory crackdown on a stablecoin is leaked to the press at, say, 2 a.m.
Oof, panic time.
Total panic. In a fraction of a millisecond, high-frequency algorithmic market makers instantly pull their limit orders off the order book to protect themselves from the unknown volatility.
So they just cancel their willingness to buy or sell entirely.
Yes.
It's like a grocery store where, upon hearing a rumor of a food shortage, the management instantly pulls every single item off the shelves and shoves them into the back room.
That's a great analogy. And if a panicked retail trader or even a slower institution submits a massive market order to sell their Bitcoin at that exact microsecond, their order sweeps through the exchange.
But the shelves are bare.
Right. Because the shelves are bare, that massive sell order finds no buyers at $60,000. It finds none at $59,000.
Wow.
It might just free fall until it finally hits a resting buy order way down at $55,000. In a continuous market, that instant catastrophic repricing creates a micro gap on the lower time frame chart.
That makes total sense.
But, and this is a big but, there is a much more practical structural reason we see massive gaps in Bitcoin, which the sources focus heavily on.
Which is?
The derivatives market. Specifically the CME, the Chicago Mercantile Exchange Bitcoin Futures.
Right. Because the CME is a traditional legacy financial institution. They operate on legacy hours.
Exactly. Yeah. Massive institutional players, the ones moving billions of dollars, they often cannot legally hold spot Bitcoin due to regulatory constraints, or they just preferred to trade cash-settled contracts.
So they use the futures.
So they use CME Bitcoin futures to gain exposure or to hedge their positions. And the CME absolutely does pause for weekends and traditional market holidays.
So you have this bizarre two-track reality going on.
Oh, completely bizarre.
You have the spot price of Bitcoin trading continuously all weekend on Binance, moving up and down based on global retail and algorithmic volume. But the CME futures price is essentially frozen in carbonite on Friday afternoon at 4 p.m.
Frozen in carbonite. I love that. And when the CME finally thaws out and reopens on Sunday evening, its price has to instantly, violently reconcile with whatever reality the spot market established over the weekend. If Bitcoin rallied $5,000 on Saturday, the CME futures chart will print a massive $5,000 wick-to-wick gap the exact second it opens.
And because institutional algorithms heavily trade those CME charts, those specific weekend gaps become incredibly powerful psychological and structural levels for the rest of the week.
Precisely. They are magnets.
Which leads perfectly into one of the most famous axioms in technical analysis, which our sources spend pages dissecting.
The fill.
Yes, the idea of filling the gap. This almost supernatural belief among traders that if the market skips over a price range, it is magnetically obligated to eventually return to that exact price and fill the empty space.
This is a very common belief.
Why does the market hate a vacuum so much?
Well, the psychology of the fill is entirely rooted in the mechanics of stranded capital.
Stranded capital, explain that.
So, when an institution initiates a massive buy program that causes the price to gap up from, say, $100 directly to $110, they bypass the entire 101 to 109 price range.
Right.
But before that gap happened, there were thousands of limit orders sitting in that zone. Retail traders had buy limits hoping for a dip. Opposing funds had sell limits hoping to take profit.
Those orders didn't get executed, they just got jumped right over.
They are completely stranded, and this creates a severe order book imbalance. You have to remember, the market is fundamentally an auction mechanism designed to pair buyers and sellers as efficiently as possible.
Okay.
Because those stranded orders represent massive pools of unexecuted liquidity, they act as a gravitational pull. As the initial violent momentum of the breakout begins to wane, the algorithms naturally drift the price back down into that empty zone to seek equilibrium.
They go back to collect.
Exactly. The market makers drop the price to execute those stranded orders, collect the liquidity, and balance their books. Once the price drops all the way back to the origin point of the gap, say that $100 mark, we say the gap has been filled.
And mathematically, once that old liquidity is absorbed, it often acts as a springboard, providing the fuel for the asset to resume its original post-gap trend.
Yes, that's the textbook gap fill setup.
But, and this is a huge but, if these liquidity vacuums happen constantly, and if the market naturally gravitates back to fill them, a listener might think the strategy is incredibly easy.
Oh, they definitely do.
Just short every gap up or buy every gap down and wait for the fill?
Free money.
Right. But jumping on every empty space is a guaranteed way to drain your trading account.
How do we separate the random algorithmic blips from the actual tradable institutional footprints?
We need to categorize them. Our sources lay out a very specific taxonomy, the core 4 types of gaps.
Let's get into the core 4, because categorization is basically a trader's primary defense mechanism.
It has to be. Your entire approach to risk, entry, and profit targets changes dramatically depending on which of the 4 gaps you're looking at. Treating them all the same is financial suicide.
Okay, let's walk through them, starting with the baseline, the common gap.
The common gap. If we're looking at a chart where a stock is just meandering sideways for weeks, it's trapped in a channel between $40 and $45, no major news, no earnings reports, and suddenly a small gap appears in the middle of that channel.
From an institutional tracking perspective, common gaps are entirely irrelevant.
Irrelevant.
Completely. They are the background radiation of the market. They usually occur simply because the order book was momentarily thin and a slightly larger than average market order came through, causing a minor slip in price.
So there's no real fundamental conviction behind the move.
None at all.
If there's no conviction, I assume the market corrects it almost immediately.
Almost instantly. Because there's no sustained buying or selling pressure driving the market away from that price, the natural drift of the auction process fills a common gap within hours, sometimes minutes.
Wow.
If you try to build a massive swing trade thesis around a common gap, expecting it to launch a new multi-month trend, you will be deeply, deeply frustrated. The professional strategy for a common gap is to identify it, label it, and then completely ignore it.
Save your energy, conserve your mental capital for the real setups.
Exactly.
Which brings us to the polar opposite of the common gap, the second category, the breakaway gap.
Oh, the breakaway gap. This is the big one.
If the common gap is background static, the breakaway gap is a starting pistol. The sources highlighted a phenomenal historical example using the daily chart for Google. Let's paint this picture for everyone listening.
Okay, let's do it.
Google's stock has been grinding upward for months, right?
Yeah.
It's approaching its all-time high.
Yeah.
Every trader on Earth is watching that specific price level. It acts as this massive psychological ceiling of resistance.
Everyone's waiting for it.
Right. The price taps the ceiling, pulls back slightly, and then the next morning, bam. The market opens, and Google completely vaults over the all-time high, leaving a massive, undeniable wick-to-wick void on the chart.
The breakaway gap is the pattern that defines institutional accumulation. It is the visual evidence of a fundamental paradigm shift in how the market values that company or asset.
But how do you know it's real? The sources are really clear that there's a specific validation tool you have to use.
Yes. The critical piece of the puzzle. The only way you validate that it's truly a breakaway gap and not a fake-out trap is by looking at the volume indicator at the bottom of your screen.
The sources are emphatic about this. A gap without volume is just hot air.
Volume is the lie detector test of the financial markets. In a true breakaway gap, that massive jump in price must be accompanied by a skyscraper of trading volume that completely dwarfs the average volume of the preceding weeks.
What does that volume actually represent, though?
That volume proves that mutual funds, sovereign wealth funds, and pension funds are aggressively hitting the market buy button.
The big boys.
The whales.
Yeah.
They aren't trying to be cute and wait for a dip. They believe the asset is so fundamentally undervalued, even at the new higher price, that they must get their capital deployed immediately, regardless of slippage.
Now, let's run a behavioral scenario here, because this is where psychology trips people up. If I am a retail trader who has studied the basic theory that all gaps must fill, I'm watching this Google breakout. My instinct is going to tell me to be patient.
Right.
I should let the stock exhaust itself, wait for it to drop back down to its old all-time high, fill the gap, and then execute my buy order to get the best possible price. Isn't that the prudent, disciplined approach?
No, that is the exact psychological trap that leaves retail traders standing on the platform while the bullet train leaves the station.
Really?
This is why taxonomy matters so much. Do all gaps fill? Absolutely not. Breakaway gaps are the defining exception to the rule.
Why don't they fill?
Because the institutional momentum is so incredibly overwhelming, the price simply does not have the gravitational pull to retrace. The buying pressure is relentless.
So it just keeps going?
It just keeps going. Sometimes a true breakaway gap won't fill for years or even decades. If you try to play the fill on a breakaway gap, you are fighting a tidal wave of institutional capital.
Yeah.
You'll get crushed.
So you just have to recognize the strength of the move and find a way to get on board, rather than betting against it.
Exactly. Find an entry on a lower time frame, but do not short it waiting for a fill.
Okay, so that acceleration phase leads us directly into gap number 3. The runaway gap, or as the sources frequently call it, the continuation gap.
The continuation gap.
This one doesn't happen at the starting line breaking out of a range. It happens right in the middle of an established trend. Let's use crypto for this one.
Okay, let's use Bitcoin.
Imagine Bitcoin has already broken out. It's been aggressively trending upward for 3 solid weeks. Everyone sees it. Suddenly, right in the middle of this vertical climb, another gap forms, violently pushing the price even higher.
Yes. This is the runaway gap, and it is driven almost entirely by the psychology of latecomers.
It's the visual manifestation of FOMO, the fear of missing out.
Precisely. For the first 3 weeks of the rally, thousands of traders were sitting on the sidelines, cash in hand, stubbornly waiting for a 10% pullback so they could buy in safely.
But the pullback never comes.
It never comes. And eventually, the pain of watching the asset skyrocket without them overrides their discipline. They capitulate.
They just give up and buy.
They all rush into the market at once, hitting market buy orders just to get exposure. That sudden, desperate rush of secondary liquidity vacuums the order book again, gapping the price higher.
And what I found fascinating in the research is that technical analysts use these runaway gaps mathematically. They literally treat them as measuring sticks for the entire lifespan of the trend.
Yes, the measuring gap principle. Statistically, a runaway gap typically occurs at the exact midpoint of a major price move.
The exact midpoint.
Usually, yes. The logic is that the initial burst of institutional buying drives the first half, and the capitulation of retail and late-stage funds drives the second half.
I see.
So if an asset breaks out at $50, trends up, and forms a runaway gap at $75, a trader can project a mathematical target of $100 for the eventual top of the trend.
That's incredibly useful. It allows you to calculate risk-to-reward ratios for the remainder of the move.
Exactly. It gives you a roadmap.
But no trend lasts forever, right? Eventually, every buyer who wants to buy is already fully invested, and the capital pipeline dries up.
Nothing goes up forever.
So how do we know when that $100 target is hit and the party is actually over? We look for the fourth and final category, the exhaustion gap.
The exhaustion gap is the most dangerous pattern on the board because it relies completely on deception.
Deception? How?
Because at first glance, to an untrained eye, it looks completely identical to a runaway gap. It occurs at the extreme tail end of a long parabolic trend, gapping the price up one final time.
So if it looks exactly like the momentum gap that just made everyone rich, how do you avoid falling for the trap? What is the mechanical difference?
You interrogate the data beneath the price, you look at volume, and you look at follow-through.
Okay, volume again.
Always volume. A healthy runaway gap is supported by sustained, elevated volume, and the subsequent candles close strongly in the direction of the trend. An exhaustion gap often prints on strangely anemic volume.
Anemic meaning low.
Very low. The institutions have stopped buying. They are slowly distributing their shares to the latecomers. Or, conversely, you might see one single astronomical spike in volume that immediately dies off.
What does that spike mean?
That's the final chaotic climax of retail buying. Everyone rushing the door at the exact same time.
It's like a car cresting a steep hill that just completely runs out of gas. The sheer momentum of the heavy vehicle carries it up those last few feet. It gaps up over the crest, but there is zero engine power left to keep it moving forward.
And gravity is about to take over instantly.
That structural metaphor perfectly describes the candlestick patterns that immediately follow an exhaustion gap. Our sources detailed a specific NVIDIA chart where this happened.
Oh, that NVIDIA chart is a textbook example.
Let's walk through it. The stock gapped up massively at the morning open. The retail traders cheered, but by 11 a.m., the buying stopped entirely. And over the next 4 hours, institutional sellers stepped in and hammered the price down. By the time the daily handle closed, it had formed a massive, bearish engulfing pattern. Let's break down the mechanics of that engulfing pattern because the sources lean heavily on it as confirmation.
A bearish engulfing pattern occurs when you have a small green candle representing the morning's gap-up optimism, followed immediately by a massive, thick red candle that completely swallows or engulfs the entire price range of the green candle.
It just deletes it.
It deletes it. The sellers didn't just push back slightly, they completely erased every single tick of progress the buyers made and then drove the price even lower.
Wow.
When you see an exhausting gap paired with a bearish engulfing candle, it is an undeniable flashing siren that the trend is dead. The remaining gap will almost certainly be filled within days, and a violent, prolonged reversal is imminent.
Okay, let's lock this in for the listener. We have our taxonomy. We know how to ignore the common gap, ride the breakaway gap, measure the runaway gap, and run for the exits at the exhaustion gap.
That's the core four.
But here's where the research pivots from general market theory into highly advanced surgical execution.
Right.
The sources plunge into the smart money concept, or SMC. This is a framework that essentially argues retail technical analysis is mostly a distraction, and that we need to use a microscopic variant of the gap to track the true puppet masters.
The smart money concepts approach is fascinating.
They focus relentlessly on something called the fair value gap, or FVG.
The shift from traditional gap trading to tracking fair value gaps is a paradigm shift in precision. Traditional gaps occur between trading sessions or days, like we talked about with the weekend gaps.
Right.
Fair value gaps occur within the continuous flow of intraday price action. The foundational philosophy of SMC is that central banks, massive market makers, and institutional algorithms dictate every single major fluctuation in price.
So it's not random.
The market is not random. It is engineered to deliver liquidity to the largest players. The FVG is the exact, undeniable footprint left behind when an institutional algorithm initiates a buying or selling sequence.
Let's construct this footprint for the listener so they know exactly what they're looking for. Because the fair value gap is not a space between two candles.
No, it's not.
It is an imbalance hidden within a very specific 3-candle sequence. Imagine zooming in on a 15-minute chart. Candle number 1 forms. It's just a standard, unremarkable candle.
Yep.
But then candle number 2 detonates. It is a massive, highly expansive momentum candle. The real body is huge. It blasts straight up, closing near its absolute high.
It's a massive move.
Then candle number 3 forms, and like the first one, it's relatively normal, maybe a slight pullback.
To find the actual gap, you have to ignore the massive body of candle number 2 for a moment.
Okay.
You draw a horizontal line at the absolute highest tip of candle number 1's wick. Then you draw a second horizontal line at the absolute lowest tip of candle number 3's wick.
Got it.
If there is empty space between those two lines, if wick 1 and wick 3 do not overlap or touch, that pristine, empty zone spanning across the massive body of candle 2 is your fair value gap.
So, Unlike a traditional gap where the price literally teleported and left a blank spot on the screen, here the screen is painted green by the body of the second candle, but structurally the order book is hollow.
Exactly. It represents a micro moment in time where price delivery was radically inefficient.
Inefficient how?
Let's walk through the institutional mechanics of why this specific three-candle structure forms. Imagine an institutional algorithm is programmed to accumulate $500 million worth of a specific asset within a 2-hour window.
Okay.
They cannot simply submit a market buy order for $500 million.
Right, because if they do that, they devour the entire sell-side order book. They'd buy the first few shares at $100, the next block at $105, the next at $120, and by the time their order finishes filling, they might be paying $150 a share.
The slippage would be catastrophic.
The slippage would destroy their average entry price. They'd become victims of their own massive size.
Precisely. To prevent that catastrophic slippage, the algorithm is designed to break that $500 million order into smaller chunks. But even a small institutional chunk is massive compared to retail liquidity.
Sure.
When the algorithm fires off the first major tranche of buys, it overwhelms the immediate liquidity tier. The price violently surges upward to find the next available block of sellers.
And that violent surge paints the massive body of candle number 2.
Exactly. The market moves so incredibly fast that there's no time for buyers and sellers to establish fair value. Only buyers were present in that specific price range.
Hence the name, fair value gap. The area is imbalanced. But wait, if they chunked the order to avoid driving the price up, why do they pause? Why does candle 3 form as a small pullback?
Because the algorithm is programmed to evaluate slippage dynamically. Once the price spikes too far from their target average, the algorithm pauses the buying program. It waits.
It just turns off.
It allows candle 3 to form, letting the short-term retail momentum traders exhaust themselves. Now, the institution still has $300 million left to deploy, but they refuse to pay the premium price up at candle 3.
So what do?
They let the natural gravity of the market drift the price back down.
Back down into the FVG.
Yes. They allow the price to re-enter that wick-to-wick void. Why? Because when they initiated that massive surge during candle 2, they moved so fast that they left a trail of their own unexecuted limit by orders behind them inside that gap. The price drifts back down into the FVG, triggering the remainder of their massive accumulation program, essentially balancing the books at a favorable price before the algorithm unleashes the next wave of buying, sending the asset to new highs.
This completely changes how you look at a chart. You aren't drawing arbitrary trend lines and hoping they hold. You are mathematically calculating exactly where a multi-billion-dollar algorithm paused its accumulation, and you are waiting patiently to step in front of the train right before it resumes.
That's the entire goal of SMC.
But the sources are hyper-vigilant about execution here. You don't just blindly hit the buy button the nanosecond. The price touches the top edge of that FVG box.
If you execute blindly at the first touch, your risk profile is completely unmanaged. This is where the smart money concept introduces mathematical rigor. The 50% rule, often referred to as the equilibrium line.
Right. The research manual instructs traders to use a Fibonacci retracement tool, or just a simple geometry box, to measure the total distance between the wick of candle 1 and the wick of candle 3.
Right.
You draw a box around the entire fair value gap, and then you draw a hard line exactly through the center. You cut the gap in half. Why is that midline so critical?
It is entirely about the psychology of pricing and institutional mandate. The top half of a bullish FVG, the area closest to where the price currently is categorized as the premium zone. The bottom half, the deeper part of the gap, is the discount zone.
Okay.
By definition, a massive institution is mandated to acquire assets at a discount. They want the cheapest possible average entry.
Makes sense.
Therefore, as an independent trader trying to shadow them, your highest probability entry, the execution that gives you the tightest, safest stop loss, is to wait for the price to bleed past that 50% equilibrium line and drop deep into the discount zone.
You demand a discount before you risk your capital?
You must. If you get anxious and buy at the premium edge of the gap, and the institutional algorithm decides it needs to sweep deeper into the discount zone to find sufficient liquidity to fill its remaining orders, you are immediately plunged into an uncomfortable drawdown.
Your screen just flashes red.
It flashes red. You start sweating out the trade, questioning your thesis, and you might panic sell right before the institution finishes buying and launches the price upward. Patience is your primary edge. You wait for the price to cross equilibrium.
Let's play devil's advocate, because trading isn't perfect. What if the price drops into the discount zone, you buy, but it keeps dropping?
It happens.
What if the macroeconomic environment shifted in the last hour? The institution abandoned their accumulation program, and the price just slices cleanly through the bottom of the fair value gap. Doesn't the entire thesis collapse? Are you just left holding the bag?
In traditional technical analysis, yes, a broken support level is just a failed trade. But the SMC framework is remarkably dynamic. When a bullish FVG is completely invalidated, meaning a full candle body decisively closes below the bottom wick of the sequence, the zone does not disappear from your chart.
It doesn't.
No, it undergoes a polarity shift. It transforms into an inverse FVG.
Like flipping a magnetic field, what was pulling price up now repels it.
Exactly. Consider the market psychology of what just happened. All the retail traders who bought inside that fair value gap expecting it to hold are now trapped and underwater, losing positions.
Oh, man.
The prices crash below them. They're experiencing maximum pain. When the price eventually, inevitably, bounces back up to retest the underside of that broken FVG, what are those trapped traders going to do?
They are going to desperately sell to close their positions the second they hit break even. They just want out of the pain.
Precisely. And that massive, concentrated wave of relief selling turns the old FVG, which was supposed to be a floor of support, into a concrete ceiling of resistance.
Wow.
The institutional algorithms know this trapped liquidity exists, so they will use that inverse FVG as a premium entry point to initiate fresh short positions. It provides the trader with a built-in, high-probability backup plan. If the long setup fails and breaks, you immediately flip your bias and prepare to short the retest.
That is a masterclass in structural flexibility. Okay, we've covered the anatomical definitions, the Core 4 taxonomy, and the institutional logic of the fair value gap. Now let's move into the practical application.
Let's do it.
We need to build the actual step-by-step trading blueprint from the ground up. The sources provide incredibly detailed chart walkthroughs, but they all insist on one unbreakable rule before you even look for an FVG.
The absolute non-negotiable foundation of this entire strategy is multi-time frame alignment. A fair value gap found in isolation means absolutely nothing.
Nothing.
It is just a random clustering of candles. Context is everything.
The sources outline a specific rule of thumb. Your execution time frame must be 2 analytical levels lower than your narrative time frame. How does a trader actually implement that workflow at their desk?
It requires discipline to not stare at the micro fluctuations all day. It means using the macroscopic view to dictate the microscopic execution.
Okay, give me an example.
Let's say your narrative time frame, the chart you use to determine the overarching trend and identify major institutional zones, is the 1-hour chart.
Yeah.
You open the 1-hour chart, you zoom out, and you look for major structural highs and lows, and you identify any massive 1-hour fair value gaps.
Right.
Once you have established that macro narrative, you do not place your trade on the 1-hour chart.
Why not? If the 1-hour chart shows a great FVG, why not just buy it right there?
Because the risk parameters are way too wide. The distance from the top of a 1-hour FVG to the bottom, where your stop loss absolutely must go, could be massive. You would have to risk a significant amount of capital or trade an incredibly tiny position size just to survive the normal volatility of a 1-hour candle. So you drop down.
You skip the 30-minute chart and you drop all the way down to the 15-minute or the 5-minute chart. You pull out the microscope.
Exactly. You leave your 1-hour FVG box drawn on the screen, but you are now looking at the 5-minute candles moving inside that box.
Okay.
You wait for the price to bleed down into the 1-hour discount zone, and then you hunt for a micro setup. A fresh 5-minute FVG forming inside the larger zone to pinpoint an entry with a fraction of the risk.
I want to walk through a highly detailed real-world chart scenario provided in the research to make this visceral.
Okay, let's hear it.
The sources analyze a Euro-USD Forex chart and simultaneously show the exact same fractal pattern occurring on a Bitcoin chart. Let's set the scene on the 1-hour narrative time frame. The market has been in a grinding, multi-day downtrend. Price is consistently making lower highs and lower lows.
A clear downtrend.
It approaches a major, established historical support level. The price dips just a fraction of an inch below that major support line, hesitates for a moment, and then violently reverses, shooting straight back up like a coiled spring.
What you are describing is the defining maneuver of institutional accumulation. It is called a liquidity sweep.
A liquidity sweep.
And understanding the mechanics of this sweep is the difference between being the predator and being the prey.
Let's look at the order book beneath that major historical support level. Every retail trader on the planet sees that support line. They bought the asset, and to protect themselves, they placed their automated stop-loss orders just below the line.
Right, meaning if the price drops below support, their broker automatically executes a market sell order to get them out. Now, put yourself in the shoes of the institutional whale who needs to buy $1 billion worth of Euro USD to reverse the trend.
Okay.
If they just buy at the current price, they face massive slippage. They need counterparty liquidity. They need someone willing to sell them $1 billion worth of the asset. Where is the largest, most concentrated pool of automated sell orders on the entire chart?
Sitting right below that support line, it's a gold mine of sell orders just waiting to be triggered.
Exactly. So the institution exerts enough short-term selling pressure to deliberately push the price just below the support level. They trigger the tripwire.
Boom.
Thousands of retail stop losses activate simultaneously, flooding the market with automated sell orders. The institution steps in and immediately buys every single one of those panicked retail sells at a massive discount.
They absorb all the liquidity.
They absorb it all. Once their $1 billion order is filled, the downward pressure vanishes, and the sheer force of their buying drives the price violently upward. That is the liquidity sweep.
They literally hunted the retail stops to fuel their own reversal. Okay, so we see this sweep happen on the 1-hour chart. The price surges upward from the sweep, and in doing so, it aggressively breaks above the most recent lower high that was formed during the downtrend. The sources labeled this specific moment as the chuch, the change of character.
The change of character is the mathematical confirmation that the overarching narrative has shifted.
How so?
When the price breaks that previous structural high, it proves that the buyers have not only absorbed the selling pressure, but have fundamentally overwhelmed the sellers and taken control of the market structure. The downtrend is officially dead.
So the trap is set. We have our narrative. A liquidity sweep occurred, followed by a bullish change of character. Our bias is now strictly looking for buys.
Right.
During that violent upward surge that caused the chuch, a massive 1-hour fair value gap was left behind. We draw our box around it. We mark our 50% discount equilibrium line. Now, what is the exact protocol?
Protocol requires agonizing patience.
Agonizing patience.
You do absolutely nothing. You sit on your hands and you wait for the price to slowly, naturally drift back down into the 1-hour FVG discount zone.
That sounds hard.
It's very hard. It might take hours. It might take a whole day. But once the price finally taps into that lower half of the box, your macro conditions are met. Now, you switch your screen to your entry time frame, the 5-minute chart.
We are looking at the exact same price action, but highly magnified. What are we looking for on the 5-minute chart? Do we just buy the first green candle?
No, absolutely not. You demand the fractal repetition of the pattern. You want to see the microscopic price action, validate the macroscopic thesis.
Okay.
Inside that 1-hour discount zone, you watch the 5-minute candles. You want to see the 5-minute candles perform a micro liquidity sweep, followed by a micro 5-minute change of character, which leaves behind a brand new, tiny 5-minute fair value gap.
It is literally a fair value gap nested inside a larger fair value gap.
It is algorithmic nesting. And that nesting is how you achieve asymmetrical risk-to-reward ratios.
How does that work?
You place your buy order at the 50% retracement of the micro 5-minute FVG. You place your stop loss just one tick below the bottom wick of that 5-minute sequence.
Right.
Because you use the microscopic chart for your entry, your stop loss might only be 10 pips wide.
Wow, that's tight.
Your risk is incredibly small. But because the overarching narrative is driven by the 1-hour chart, your profit target is all the way up at the 1-hour structural highs.
So you are risking $100 to potentially make $1,500. You are engineering a 1 to 15 risk to reward ratio because you perfectly aligned the time frames.
Exactly.
Now, the sources didn't just leave us with theory. They provided a massive data set analyzing a very specific time-based application of this strategy centered entirely around the opening bell of the United States stock market at 9:30 a.m. Eastern Standard Time.
This is great data.
And they contrasted two very distinct operational tempos, scalping versus day trading.
This specific data set is phenomenal because it strips away the theory and confronts the reality of human psychology.
Right.
The 9:30 a.m. open is the most volatile period of the day. It is the exact moment when the massive institutional algorithms wake up, process the overnight macroeconomic news, and violently rebalance their portfolios. It is chaotic, and it creates massive fair value gaps.
Let's break down the hyper-aggressive approach first. The scalping setup. Imagine a trader sitting at their desk, coffee in hand, staring at the screen. It is 9:30 a.m. The bell rings.
Okay.
The sources dictate that you open the 5-minute chart and do nothing for exactly 5 minutes. You let the very first 5-minute candle form. At 9:35 a.m., that candle closes. You immediately draw a horizontal line at the absolute high of that candle's wick and a line at the absolute low. You have functionally boxed in the opening volatility.
You have established the initial opening range. Step 2 requires immense focus.
Wow.
Because you are scalping, you drop down to the most chaotic time frame available, the 1-minute chart. You're watching 1-minute candles violently bounce around inside the box you just drew. Your trigger is a breakout. You wait for the price to aggressively smash out of that 5-minute range, either breaking above the high line for a long bias or below the low line for a short bias.
But it can't just be a wick poking through the line, right? The sources are clear on this.
No, it must be a structural break. The price must break out and specifically leave behind a 1-minute fair value gap as it crosses the line.
Oh, I see.
That gap proves that institutional momentum, not just random noise, drove the breakout. Once that 1-minute FEG is established outside the opening range, you wait for the immediate retracement back into the gap.
But because we are on the 1-minute chart and the market is moving at light speed, the protocol demands one final layer of safety. You do not use a blind limit order to buy the touch. You wait for confirmation.
Yes. You must wait for visual confirmation that the buyers actually stepped in where they were supposed to. You watch the price dip into the FEG, and you wait for a 1-minute candle to print a reversal pattern, specifically the engulfing candle we discussed earlier.
Right.
If it's a bullish setup, you want to see a red candle dip into the gap, immediately followed by a massive green candle that completely engulfs it.
The moment that green candle closes, you execute the market buy. You place your stop loss just below the lowest wick of that engulfing sequence, giving it maybe 1 tick of breathing room so you don't get stopped out by spread.
Yep.
And the sources target a fixed, non-negotiable 3-to-1 reward to risk ratio. You take your profit when you hit 3 times your risk.
And the thousands of back-tested trades in the dataset show that this specific, rigid scalping protocol yields an incredibly impressive 70% win rate.
A 70% win rate with a 3-to-1 reward ratio is mathematically absurd. You would print money.
You would.
But, and this is the massive, glaring, but hidden in the research, executing this strategy requires inhuman split-second emotional control.
That's the catch.
You are staring at a 1-minute chart during the most volatile time of the day. Every single twitch of the price feels like a heart attack. If you hesitate for 10 seconds out of fear, the engulfing candle closes without you, the price rockets away, and the trade is entirely gone.
Gone.
The psychological toll of operating at that tempo is devastating for most humans, which is exactly why the sources provided the alternative, the day trading setup.
The day trading setup relies on the exact same structural logic, but it intentionally slows the heartbeat of the market down to a manageable rhythm. It removes the micro fluctuations.
How does it do that?
Instead of boxing in the 5-minute chart, you start on the 15-minute chart. The bell rings at 9:30 a.m., and you literally do not touch your mouse until 9:45 a.m.
You just watch.
You let that massive first 15-minute candle absorb all the chaotic opening institutional flow. Once it closes, you mark the high and the low.
You've created a much wider, more stable opening range box, and then instead of dropping into the anxiety-inducing 1-minute chart, you only drop to the 5-minute chart.
Correct. You watch the 5-minute candles interact with the 15-minute range. You wait for a 5-minute candle to decisively break out of the box and leave behind a 5-minute fair value gap.
Okay.
But here is the fundamental shift in execution protocol. Because the 5-minute time frame is vastly more reliable and structurally sound than the 1-minute time frame, you do not need to wait for a stressful split-second engulfing confirmation candle.
You just set a trap. You place a blind limit order right at the 50% equilibrium line of that 5-minute FVG. You set your stop loss mathematically below the sequence, and you literally step away from the keyboard.
You remove your own anxious interference from the trade. You target a slightly more conservative 2-to-1 risk-to-reward ratio. You let the market do the work. You do not micromanage the position.
And here is the most shocking revelation in the entire data stack. When they back-tested this slower, supposedly less optimized day trading strategy, it yielded an 81% win rate.
81%.
It significantly outperformed a hyperactive, high-stress scalping strategy in overall consistency.
What is deeply profound about that data is what it reveals about the flaw of human nature in systems design.
How so?
On paper, the scalping strategy offers a higher reward multiplier. But the human error introduced by trying to execute perfectly under extreme adrenaline on a 1-minute chart degrades the practical performance for almost every trader.
Don't hesitate. You panic.
You hesitate, you enter late, your stop loss gets skewed, and the 70% win rate collapses. The day trading strategy acknowledges human weakness.
It builds it into the model.
Exactly. It forces you to act like a machine. You calculate the box, you set the limit order, you accept the slightly wider stop loss, and you eradicate your own anxiety from the execution chain. It is vastly more forgiving.
It's not about finding the mathematically perfect setup. It's about finding the setup you can actually execute without sabotaging yourself.
That's the secret.
Which bridges us perfectly into the final section of our deep dive, part 5. Risk management and the psychology of the gap. Because as that data just proved, the most elegant, algorithmically precise smart money strategy in the world is absolutely useless if human emotion dictates the position size.
Risk management is the only operational difference between a professional trader running a business and a gambler pulling a lever at a casino.
That's sad but true.
We've spent an hour detailing where to place the stop loss functionally on the chart. Beneath the sweep, beneath the FEG wick, giving it a buffer tick to survive the spread. But the chart placement is only half the equation.
What's the other half?
The other half is the spreadsheet mathematics of your account size.
Let's run the math. If I have a $10,000 trading account and I see a pristine 1-hour nested fair value gap that aligns perfectly with the 9:30 a.m. data, it's an A+ setup. I shouldn't bet $5,000 on it, right?
If you bet 50% of your account on a single setup, you are guaranteed to blow up your account eventually. Guaranteed.
It's an A+ setup.
Let's look at the best case data we just discussed. An 81% win rate. That is phenomenal.
Yeah.
But statistically, an 81% win rate still dictates that you will lose roughly 2 out of every 10 trades.
Right.
And probability dictates that those losses will not be perfectly spaced out. You will eventually hit a variance cluster where you lose 3, 4, or even 5 trades in a row.
Oh man. If I risk 20% of my account per trade and I hit a 5-trade losing streak, my account is completely wiped out. The strategy was profitable, but I went bankrupt.
Which is exactly why institutional risk models cap exposure rigidly. Professional retail traders risk a maximum of 1%, perhaps 2% on an absolutely perfect setup of their total capital.
So on your $10,000 account, you were risking exactly $100 per trade.
Exactly. The fair value gap dictates where you enter and exit on the chart. Your mathematical risk parameter dictates how many shares you are allowed to buy.
Wait, break that down for me.
If the FEG is exceptionally wide, your stop-loss distance is larger, which means you must buy fewer shares so that if it hits the stop, you still only lose exactly $100.
The risk is fixed. The position size is dynamic. That keeps you alive.
That's how you survive a 10-year career.
But beyond the math, the sources dedicate significant ink to the psychological traps of gap trading. And the most dangerous one is the allure of the gap and go strategy.
Gap and go is pure adrenaline.
Tell me about it.
It happens during a breakaway gap. A stock opens 15% higher on massive news, the green candle is just surging vertically on the 1-minute chart, and every biological instinct in your body is screaming at you to click the buy button right now before it goes without you.
It looks like free money. You feel like you are standing on the tracks watching a train full of gold pull away, so you chase it. You just hit market buy at the top of the candle.
And the moment you do that, you have abandoned the entire framework. Entering a gap without confirming the volume profile, without waiting for the structural change of character, and most importantly, without demanding a retracement into a mathematical discount zone, you are no longer trading the institutional footprint.
You're just gambling.
You are just gambling on momentum.
And the market is ruthlessly efficient at punishing that impatience, isn't it?
Incredibly ruthless. What usually happens when you chase a gap and go is that the asset might run for another 10 minutes, exhausting the last bit of retail capital. Then the institutions decide it's time to balance their books.
Uh-oh.
The price violently snaps back to fill the gap or test an FEG. It plummets past your chased entry point. It triggers your panic stop loss. You take a massive loss, and then the algorithm finishes its rebalancing and the price resumes its upward trend without you.
You were right about the direction, but you were destroyed by your execution. So what is the psychological countermeasure? How does a trader physically sit at a desk, watch a chart explode, and possess the discipline to not click the button?
You have to fundamentally rewire your relationship with missed opportunity. Patience is the ultimate overriding edge in financial markets.
It's harder than it sounds.
It is more important than any indicator or Fibonacci tool. You must internalize the absolute truth that there is always another trade.
Right.
The market will open again tomorrow. It will open again next week. If an asset gaps and runs and it never gives you the mathematical retracement to your FVG discount zone, you must let it go.
You just watch it.
You watch it fly away, and you feel absolutely nothing. You accept the professional reality that a trade leaving without you is infinitely better than a trade taking your capital with it. The discipline to only execute when your specific pre-calculated parameters are met is the hardest skill to learn, but it is the only psychological framework that survives over a decade.
A trade leaving without you is infinitely better than a trade taking your capital with it. I think everyone listening needs to engrave that on a plaque and mount it above their monitor.
I agree.
Okay, we have covered an immense amount of ground today. We are at the end of our deep dive into these sources, and it is time to synthesize this journey. We started by simply looking at a void on a chart, a missing step on the staircase.
We did.
We learned how to isolate the noise by demanding wick-to-wick vacuums. We mapped the core 4 taxonomy, ignoring the common gaps, recognizing the massive institutional volume of breakaway gaps, projecting targets with runaway gaps, and surviving the deceptive traps of exhaustion gaps.
And then we pulled out the microscope. We adopted the smart money concept, tracking the exact algorithmic footprints through fair value gaps.
Yes.
We established the rigid rules of engagement, waiting for the institutional sweep of retail liquidity, demanding the structural confirmation of the change of character, mathematically insisting on a discount entry at the 50% equilibrium line, and always aligning our micro execution with our macro narrative.
And we proved with hard data that slower, robotic execution on the 5-minute chart mathematically outperforms the chaotic anxiety of 1-minute scalping.
The data doesn't lie.
But before we wrap up, I want to pull back from the charts entirely. What is the broader philosophical takeaway from all of this research? Why does this architecture of gaps and imbalances actually exist?
Well, if we look at the overarching academic theory of finance, you will constantly hear economists talk about the efficient market hypothesis.
Right.
It is the doctrine that all available information is instantly and perfectly priced into an asset, and that the market is a flawlessly rational pricing machine. But the existence of gaps proves that this hypothesis is a myth.
A total myth.
Markets are not flawless machines. They are entirely human constructs. They are driven by massive institutions that, despite their algorithms, are operated by human managers subject to mandates, bursts of greed, panic, structural delays, and severe liquidity bottlenecks.
So they make mistakes.
The empty space on the chart, the gap, is the ultimate undeniable visual proof of market imperfection. And for a trader, imperfection and inefficiency is exactly where the opportunity lives. If the market were perfectly efficient, there would be no gaps, no imbalances, and no profit to be made.
Imperfection is where the opportunity lives. You are quite literally trading the market's structural mistakes. That is a brilliant framework. So we turn this over to you, the listener. Take a look at your own trading approach. Do you trade gaps in your own portfolio?
I'd love to know.
Have you ever been caught emotionally chasing a runaway breakaway gap that suddenly violently reversed and swept your stop loss? And more importantly, when the market suddenly jumps and that massive green candle is flying across your screen, how do you manage your risk parameters and keep your own adrenaline in check?
It's the ultimate test.
Think about that missing step on the staircase. The next time you see that void on the chart, don't stumble blindly into it. Use it to calculate your next climb. Thank you so much for joining us on this deep dive. Keep questioning the charts, keep looking for the narrative in the negative space, and we'll catch you next time.